SEBI plans to establish stricter disclosure regulations for New Age's IPO. Mumbai, market regulator Securities and Exchange Board of India, has proposed to tighten disclosure standards for new age companies that plan to float initial public offerings. According to a discussion paper floated by SEBI on Friday, such companies will have to disclose more details pertaining to how they arrived upon the offer price for their IPOs. This proposal aims to cover only those companies which don't fulfill the 3-year profitability track record, while the rules remain unchanged for others. The development comes as the stock prices of several newly listed technology companies tumbled post their listing over the last few months. In the discussion paper, SEBI observed that the current IPO rules only require companies to disclose traditional parameters, such as key accounting ratios. However, since the new age companies are usually loss-making, the regulator felt there was need for additional disclosures. SEBI proposed that such companies will have to disclose their key performance indicators during the IPOs. Typically, startups use various statistical models such as gross merchandise value to make revenue projections. Private equity and venture capital investors who buy stakes in unlisted startups typically go by such KPIs. The issuer companies shall disclose all material KPIs that have been shared with any pre-IPO investor at any point of time during the 3 years prior to the IPO, said SEBI's discussion paper, adding that the companies shall also make disclosure of valuation of issuer company bar SED on secondary sale, acquisition of shares excluding gifts, in the 18 months prior to the date of filing of the DOHP, where either acquisition or sale is equal to or more than 5% of the fully diluted paid-up share capital of the issuer. To be sure, these new proposals will apply to only those companies which have not been profitable in the last 3 years and are planning an IPO. Discover the stories of your interest: blockchain 5 stories, cyber safety 7 story, fintech 9 stories, ecom 9 stories. Milliliters 8 stories, edtech 6 stories. Indian markets witnessed a flurry of IPOs by technology companies since mid-2021. Food delivery app Zomato was the first to float a public offering, followed by others like Policy Bazaar, Patemandnik Hour. The share prices of all these companies have corrected post their IPOs, prompting criticism amongst market participants, saying the issuances were price steep, leaving little money on the table for the IPO and post-IPO investors. The new age technology companies generally remain loss-making for a longer period before achieving break-even, as these companies in their growth phase opt for gaining scale over profits, SEBI said. Investors are onboarded on these companies on the premise of future potential, and accordingly the company strives for long-term market leadership rather than short-term profitability considerations.